accommodations. And then after the financial crisis, she applied for a job at the New York Fed because she says that she wanted to do something that would sort of help the financial system and help prevent these kinds of things from happening in the future.
Okay, so she comes there at a time when the country is focused on stricter regulation of financial institutions and the dangers of financial institutions that get out of control. She's in the Fed for a few months and she gets involved in one particular deal. We heard that reference to that deal that was described on the tape at least as legal and shady. What was it?
Yeah, this deal shows up in discussions throughout her tapes. It was a deal between Goldman Sachs and a Spanish bank called Banco Santander. And Santander was being required by its regulator in Europe to hold more capital, a cushion in case things go wrong.
Oh, this has been a big deal since the financial crisis, that institutions are supposed to have the equivalent of cash on hand in case of a crisis.
Exactly. And so what Goldman was doing was they were taking some of the assets off of Santander's books. They were going to hold them for a few years, which would let Santander hold less capital.
Okay, so this transaction is happening. Carmen Segarra, among other people at the Fed, find out about it. And this is a point where Carmen Segarra is already questioning the strength of her colleagues at the Fed, the strength of their effort to oversee Goldman, and she's making recordings, which we're about to play some of one. What's on this tape?
We're about to listen to Mike Silva. He's the head Fed official inside Goldman Sachs. And he wants to question Goldman executives about this deal and ask some sharp questions. He's got some concerns.
My personal thinking right now is that we're looking at a transaction that's legal but shady. I want to put a big shot across their bow on that.
Mm-hmm.
Poking at it, maybe we find something even shadier than we already know.
Okay, you hear him say, I want to put a shot across their bow. I want to warn them that there is a problem here. Then he goes into the meeting with Goldman, as other Fed regulators do, and there's tape of that. What happened in that meeting?
Well, although the deal is legal, there is one thing about the deal that seems to require an explanation. Goldman had a clause in the agreement that said that they needed to obtain a no objection from the Fed for the deal. So essentially, it seemed like the Fed had to sign off on the deal before it was closed. But as Silva says, he doesn't feel like he got that sign-off.
Silva is saying Goldman took me for granted and just assumed I would approve this. They didn't get my approval. He's got something to really question them on. So did he push Goldman when he finally met with the bank?
Well, you can listen to the question yourself and make that determination.
Just to button up one point. I know the term sheet called for a notice to your regulator. The original term sheet also called for expression of non-objection. Sounds like that dropped out at some point, or?
Sounds like that dropped out at some point. Is that the only question that was asked in that long meeting?
Yeah, that's the only time that Silva asks about the no objection issue. Goldman did mention it in the meeting, and they said that the clause didn't actually mean what it appeared to say, and that in fact they didn't require a no objection from the New York Fed.
Okay, so Goldman Sachs is doing this big transaction. Fed officials notice a problem. They want to really question it. They go into the meeting with Goldman, and they barely raise it. And Carmen Segarra keeps right on recording. After this meeting with Goldman, what did Fed officials say, if anything, about why they didn't press their own concern?
Well, they go back to their own floor on Goldman Sachs, and they start talking about the meeting. The no objection doesn't really come up at all. But they start expressing their feelings about how far they should push Goldman Sachs.
I think we don't want to discourage Goldman from disclosing past right in the future, and therefore maybe some comment that says don't mistake our inquisitiveness and our desire to understand more about the marketplace in general as a criticism of you as a firm necessarily. Like I don't want to clear them on the back of the head and say, screw, we're not doing this. We're not going to disclose again. We don't need to.
So they're saying we need to be gentle with Goldman Sachs.
Yeah, Segarra says that she saw this a lot, that there was a fear that if you pushed Goldman too far, they wouldn't give information to the Fed, which she didn't understand because Goldman is obligated to give information to the Fed when it asks for it.
Okay, now Carmen Segarra, we should say, has since been fired from the Fed. She sued, saying that she was fired because she was considered too aggressive. What is the Fed saying about her case, and what is Goldman saying about all this?
The Fed says that the decision to terminate Segarra's employment was based entirely on performance grounds and not for any concerns that she raised about Goldman Sachs in her examination. Goldman Sachs says the concerns that Segarra raised in her examination were off base.
I want to emphasize that even though you have dozens of hours of recordings here, secret recordings, what you have is a snapshot in time of an incredibly difficult and long-running job of regulating banks. So I just want to ask you, Jay Bernstein, is there anyone besides Carmen Segarra, the woman who made these recordings, who says the Fed has just been too gentle on the banks?
Actually, the Fed did. They commissioned an outside report in 2009 that said that the biggest problem at the Fed was its own culture, the deference, the fear of speaking up, and suggested that they hire expert examiners who would speak out and contradict their bosses, people like Carmen Segarra.
Jake, thanks very much.
Thank you.
That's reporter Jake Bernstein with ProPublica. You can hear much more of this story this weekend on WBEZ's This American Life and find it at thisamericanlife.org.
Okay, so here's your quiz question. Got two of them for you. One, what is your reaction to the report? Number two is, what is the appropriate response to the findings in the recordings? About 5 minutes to work on that. up. Exchange your paper with somebody for grading. Doesn't matter who. You can just swap them around as long as you don't have your paper at the end of the day. You can swap right here, Corbin. You guys can do it through. It doesn't matter who you swap with, so. As long as you don't have your paper, that's all I care about. All right, so reactions. Give me a number between 2 and 8. 7. 1, 2, 3, 4, 5, 6, 7. And what does your paper have on it? Not your reaction, but whoever you got on your paper. What's the reaction? Read it word for word, please.
I think it's very interesting that even the Fed itself, as formally recognized its problem with being too cozy, and yet it continues to have it and even rejects those that would help solve the problem.
Okay. So, other reactions. What do you think? Surprising? Not surprising? Not surprising? What's that?
I think it needed to happen.
What needed to happen?
But I agree with what Carmen, she needed to say something.
Okay.
Because, I mean, they wanted something to occur in the first place, so
Mm-hmm.
she just did what she felt was needed.
Surprised that she got let go? What's that?
It's kind of shady that she got one.
Yeah. There's no kind of multi-layered shadiness going on here, right? So, what else? Other reactions? Other comments?
At the end of the day, in today's system, money is always going to win. So if you try to stir the pot, when you're going to lose your job, they'll discredit you any way they can. So it's at a point where even the Fed is afraid to really, like they said, afraid to ask the questions or really push it because they might stop giving them information, even though they're legally obligated to.
So, why do you think they're, and I'm opening this up to anybody, why do you think they're, I guess, afraid to approach, or why don't they confront companies like Goldman Sachs? This is probably just one example.
Cuts into the profits.
Yeah, but why do they care? They don't have their profits don't matter. Why is there even a concern? Why is this even an issue?
Well, they personally invest in Goldman Sachs.
What's that?
They personally invest in Goldman Sachs.
Possibly, that's one. So we might have a conflict of interest with the actual regulator might own shares of Goldman Sachs. So that's a possibility. Okay, good. What else? Because it might cut into the profits, but in theory, that's the whole purpose of the regulation, is to not cut into profits, but to make sure that they're staying within the bounds of the law. They're lazy people. That could be too. I mean, we do have, so we've got kind of a couple people biases that are entering into the equation, right? And I think a lot of people forget that the government is made up of people, and those people have the same sorts of emotions and feelings that we do, and it sometimes leads to what we call government failure. So what this kind of, all of that discussion kind of starts to lead to number 2 here. I mean, what's the appropriate response? What do you think? What did you guys come up with for some appropriate responses? Corbin?
The appropriate response to the findings in the recording is not to be gentle to Goldman Sachs, but to have even more regulatory power over them.
Okay.
Carmen should win her lawsuits, and more questions should have been asked inside the meetings from the feds.
Okay. Other people? Yeah.
My paper says, I think an appropriate response to the recording is that the
Okay. Other people. Other responses. So we got Corbin's was kind of more regulation. Yours said an apology. What else did it say with yours, Dylan? Was there something? I heard the apology part, and then was it kind of similar with
Open to the public,
open to the public? So what would be open to the public?
the meetings.
Okay, the meetings. And open meetings. Okay, so that might be a policy change. Instead of closed door meetings that the Fed has with them, should we be open to the public? Should all of those meetings be recorded? Okay, other responses, other policy changes? Yeah.
I personally don't mind that the Fed, the big banks and the Fed should be more regulated by the government as far as their repercussions for breaking the law or doing quote unquote shady things.
So you want the Fed to be regulated too? Big banks and the Fed, you said, should be regulated?
Cigar lost her job, but her bosses should have lost their jobs, not her. The people
So-
who are afraid to ask the questions. The ones who lost their jobs, people with Goldman Sachs.
So would it be good to have another area of government watching the Fed? Like, who's going to watch the watcher?
No,
The Fed's supposed to be watching the bank, but then we don't trust the Fed now, we learned. So now we need another government agency to watch the Fed. So we need a watcher for the watcher. Is that the direction we should head?
No, we should just hold the Fed more accountable. The people in charge of the Fed.
Okay.
Like, you're held accountable for the stuff that you say in class. So, and you're accountable to President Eichner in the same way. They should be accountable to whoever is in charge of their departments instead. And then those people in the banks, when they do sketchy stuff, should be held much more accountable.
Okay. Yeah.
Mine says that just because it's shady doesn't mean that it shouldn't be done or can't be done since it's legal, so there should be no action taken on Goldman.
Okay. So what becomes difficult pretty fast is, especially if companies are pushing the envelope of financial innovation, is this area that they're delving into crossing the line? Are they stepping up to the line? Or is there even a regulation on the books that covers that, right? So there might not be a law. In order to determine that, we probably need a judge and a court and a bunch of things. So what was the Fed's logic, if there is any, of not wanting to record the conversations, not keeping them public? What would be their argument back?
Well, they discuss crucial financial information that banks don't have to release, or some investigations don't have to release.
Yeah, I think there's the argument that they're making, whether it's right or not, is that they might be able to gather more information and kind of watch things a little better if they're not recording every conversation and doing that, right? If they're kind of that fly on the wall as part of the arguments that are made.
I don't know if the Fed's ever made this argument, but I feel like it might have a strange effect on the economy whenever they're trying to influence the supply of money and then that's publicized before it happens.
Mm-hmm. Yeah, that could be too. It ends up being a pretty complex topic on what the right thing is. Is it more regulation? Is it possibly less regulation? I mean, is the regulation the problem?
You can't exploit the loophole if there's not a rule about it.
Yeah. So another approach would be to kind of write clear rules of law and kind of take that aspect out of it. So maybe the market, in some cases, maybe the market might correct itself if we, in terms of accountability, let the people who invest in Goldman Sachs suffer the consequences if Goldman Sachs is doing something wrong, perhaps, right? So we raise maybe the disclosure level, although I think it's probably fairly high in terms of what paperwork needs to be disclosed, and it's probably so complicated that the average Joe doesn't want to pour through every little detail anyway. But is it better to let the market system correct itself? And then the companies that are doing bad or failing don't get bailed out. They fail and people lose money, and then they learn that they should be reading some of the fine details in the disclosure statements of companies so that they can pick the winners and the losers instead of the regulators getting cozy, and perhaps they own a share of that stock too. So the solution might not always be more government or bigger government. Maybe we need to think creatively if we can turn things. I don't know. This is a complicated issue. Competition is one way that the market system tries to defeat stuff like this, so that there's not a concentration of power with the big business or the big entity. Because that big entity is the Federal Reserve. They kind of hold a lot of power, and so that can cause problems in and of itself. So we kind of look at those issues of concentrations of power where competition is lacking. Perhaps we can deregulate things and somehow increase competition. Might be an approach. All right, so last time we put up the big banks, and so this kind of ties right into looking at the banking system. The United States, from a global standpoint, has a lot more banks than other industrialized countries. So we've got 6,500. Part of this is due to the Glass-Steagall Act that we learned about last time. That I think due to these types of issues, said we don't want banks to get too big. We like the idea of small community banks, let these banks compete with each other. And so we had a number of banks that evolved over time. And then since we've gone towards the deregulation of the industry, we've had some banks fall as some financial crises have come in, and banks have gotten bigger and bigger. So what do you think is the most startling thing about this? I kind of kept it up here so you guys could slowly digest it instead of just flipping it up there. Number of banks, share of banks, share of assets held. Is that thing?
So the top 1% of all the banks hold 73% of the assets. Or if you want to add the next one, it's even started more surrounding, the top 7% of all the banks hold 85% of all of them.
Yeah, if you combine these two together. Yeah. So we definitely see the concentration in power in the numbers here. And so possibly one response to that might be, instead of coming up with a bigger rule book and a more regulation, would be to kind of break apart some of that system. Now, what's some of the disadvantages of doing that? Is there any disadvantages? I think there's one, that economies of scale, although I think to me this is probably a smaller issue in this case compared to the benefits of maybe having more competition. Economies of scale. What was that? As you increase the scale of production, larger volume, what happens? Cost goes down. Yeah, so technically economies of scale is that long-run costs fall as we increase the scale of bank, as the size of the bank increases, the more able they are to offer products and services at a lower cost because of economies of scale, and then also economies of scope, which is what part of the deregulation came from, is allowing financial institutions and banks to offer these other securities. And so instead of just running the banking business under the Glass-Steagall Act from 1933, where we want banks to just take in deposits and make loans. That's your job. That's what you can do. That's all you can do. You can't get involved with Wall Street and big banks, and we'll let separate companies handle that function. Deregulation allowed those companies to get involved with that. Okay, So that's some things to chew on. I'll let you read through these.
Quick question.
Yeah.
About, this is backtracking a little bit, but if Goldman Sachs was holding those assets so that the bank, that's name I probably can't pronounce, wouldn't have to hold as much, wouldn't that mean that Goldman Sachs would have to hold more in reserves?
If they're not a bank, they don't have the reserve
okay,
requirement.
that's right.
Yeah, that's right. So, and that's kind of the shell game. Those sorts of things evolve from these loopholes we talked about. It's like, oh, okay, Mr. Government Regulation, you say we can't do this. Well, I can do this, which is more inconvenient and probably less transparent, but I can achieve my objectives by creating this other company over here, and it runs through these set of books, and now we have two entities, right? So what my general observation over time is that the market tends to win in terms of finding creative solutions, because business people are creative. They're just like artists in a way. You give us these constraints through the rules, and it's not that we're going to break the law, but the profit chasing, the profit maximization for the long term, not always bad, that it's short run profit maximization, that's not an evil. In fact, we've learned in some principles classes that can be very good for society in terms of growth and alleviation of poverty, for instance. So there's lots of good things going on that we believe, and as we start to see some bad behavior, the response of more regulation tends to not necessarily stop the bad behavior, but causes the bad behavior to manifest itself in some other way, right? So it kind of changes. We think that we do a rule or a law and it'll do it, but it kind of creates another thing, and then we plug that hole, and then we move over and they do something else, and then we plug that hole, and then we plug that hole, and then we plug that hole, and from 1933 up to today, the rule book was this thick, and now the rule book is this thick, with thousands of pages in it, and we still got the same thing going. The answer each year is to make the rule book a little thicker, and so maybe we can get creative on how to get better results without just resorting to a new rule on the book. All right, so these are the number of banks. I think we did this slide last time. So 1985, we were at 14,000 banks. And then we had kind of some bad times in the 80s, a lot of bank failures, mergers, and then that trend has kind of continued. So here's the 6,000 mark that we're at today. Okay, so we talked about Glass-Steagall. I got one little other video that talks about the 1999 deregulation. That's where we saw most of these rules kind of lifted with changing the banks allowed to get into more things. On the face of it, it might have sounded good, but having more things meant more things to regulate, right? More complexity, and I think that proved pretty difficult. And so perhaps keeping it simple was a better idea. All right, so this will wrap up. This is a nice little video that I found, and this will wrap up chapter 12. And then Sunday you'll have your stuff due for the 10 and 12.
March 6, 2009. The United States stock market hits a 10-year low when the Dow Jones Industrial Average falls to 6,507, marking the low point of a 2-year time period where the stock market dropped 54%. The question isn't how this happened, it is why. We know how the economy collapsed, but what many do not know is why this happened. What reform in finance caused such an adverse reaction? The cause behind the financial collapse of 2008 is revolutionary reform in financial policy. The government, whose job it is to protect a prosperous way of life for its citizens, instead gave in to the demands of the banks. The reaction was the largest recession since 1933, 75 years prior. The issue begins with regulatory changes in reaction to the Great Depression. The Glass-Steagall Act, financial reform passed in 1933, stated that all bank deposits are insured by the Federal Deposit Insurance Corporation, or FDIC, that the Federal Reserve has the power to regulate interest rates and savings accounts, and more importantly, that retail banks, banks taking deposits, and investment banks who make risky investments with clients' money may not merge. This was reform that was needed in order to prevent another depression. The bill successfully accomplished this. However, as time went on, financial regulation loosened. In 1997, the United States was in excellent financial shape in the midst of Bill Clinton's second term. The economy peaked to an all-time high in July of 1997. Unemployment had dropped below 5% for the first time since 1972, and the country was left with a budget surplus.
Reform begins in 1998. Citibank merged with Travelers Insurance, violating the separation provision that was the main reform written in the Glass-Steagall Act that was passed after the Great Depression. Thus begins the merger of banks and the formation of Citigroup. On November 12, 1999, the separation provision in the Glass-Steagall Act was permanently repealed with the financial reform detailed in the Financial Services Modernization Act. This bill was the reaction to Citigroup and the revolutionary change sponsored by 3 Republicans, Senator Phil Gramm and Representatives Jim Leach and Thomas Bliley. Following the Financial Services Modernization Act, the line between retail and investment banking was non-existent, meaning that banks could now take deposits from customers, give loans, and use the money to make risky investments in stocks and derivatives. This was a foreseen and intended reaction. What was not intended was this. Due to reform commuting risk, banks no longer had to deliberate over who they gave loans and mortgages to. Under the old system, retail banks and lenders giving mortgages had to be very careful because one bad mortgage would be on the books for years, and the losses from such a mistake could cripple the bank. This led to numerous credit checks, high down payments, and hard limits on who could receive a mortgage or loan. In a world where risk is paramount, it was placed firmly on partners and executives in the bank. Now, post-reform, the risk of the retail bank was commuted to the shareholders of the investment banks that now held these mortgages. There were still regulations in place to control trading and leverage, meaning that for these investors there was a certain degree of safety, as banks could not grossly overspend. What was missing was a set of regulations in place to control who could take out a loan. This is the deregulatory aspect of the Financial Services Modernization Act that caused Wall Street to react by exploiting the new reform to spin profits thought to be impossible. So how did these profits increase? To understand this, one must understand how banks profit from mortgages. Money from mortgages is made from the fees and the processing charges on the front end of any loan and from the interest rates charged on that loan. An ideal mortgage for a bank used to be a safe mortgage, one given that had a failure rate close to 0. While the lower interest rates on a mortgage to someone with good credit would limit profits, their high probability of paying off a loan would also limit loss, meaning that the bank would make low-risk profits. It was assumed, as in 1999, that this would stay constant. How could a risky loan, one likely to fail, possibly be better for a bank than a sure bet? Truth is, this assumption was, at its core, correct. For the long-term health of the bank, safe loans are always best. But, reacting to financial modernization reform, these were not the most profitable for those giving the loans. The most profitable loans for banks, short-term, and subsequently the worst for the bank itself, were called subprime loans. A subprime loan is defined as a loan given to a borrower with a poor or low credit rating. These loans have high interest rates and require the borrower to accept less favorable terms than someone with a high credit score. These loans make banks more money due to the higher interest rate, but have a high failure rate due to the limited credibility of the borrower. The occurrence of these loans prior to 1999 was 5% of all loans, but in reaction to the reform detailed in the Financial Services Modernization Act, the number of these loans given substantially increased to 20% of all loans. What all this meant, on the surface, was that more Americans could own houses and banks were making more money. Unfortunately, the underlying truth of this was that more money was being borrowed by people who in the past would not have and should not have been able to borrow it. This meant the banks had more potentially toxic assets on their hands than ever before, and millions of people owned houses they couldn't afford. The huge number of subprime loans given led to what economists call a bubble, meaning growth is being created that can only last for a finite period before eventually coming to a swift end. In reality, a drop in the economy of 3% would have caused a crippling reaction. The majority of subprime loans would be sent into default, meaning the holders of the loans would be unable to meet scheduled payments. If this were to happen, banks would react by foreclosing on the property, seizing it and putting it up for sale. This would hurt the banks by forcing them to have real estate holdings they had to sell quickly. Property values across the country would plummet as vacant houses abounded in America's neighborhoods. The failure of these loans would cause negative reaction in one last realm. The single most important aspect of this crisis, the derivatives market. Specifically, collateralized debt obligations, various types of loans made into complex asset-backed securities. These CDOs allow banks to reduce the liability they have if loans are to fail, raise capital, and allow others to share the bank's risk as well as profit. CDOs are rated by 3 rating agencies, Moody's, Fitch, and Standard & Poor's, who are paid by the investment banks to determine the risk involved in a certain investment. These agencies are paid more for every CDO they rate and thus fail to diligently provide ratings, preferring to maximize AAA ratings and therefore maximize profit. CDOs are then given an interest rate that is inversely proportional to their rating. A high AAA rating is almost no chance of failure and therefore receives a low interest rate, which limits what the investor can make off it while also limiting what they can lose. Conversely, a B CDO has a high interest rate due to its high risk. Just like any other asset, a CDO can be underwritten through a form of insurance, though one vastly differs from standard insurance in that anyone can insure it. In contrast to a house, car, or boat where only the owner may insure it, derivatives can be insured by any speculator in the form of a credit default swap, or CDS. Normally, a holder of a CDS is simply hedging their bet on a derivative, paying a yearly premium to prevent loss. But, in the case of many of these subprime-backed CDOs, speculators would pay the insurance premium to enable themselves to get full valuation of the derivative when it failed. This system would work because the CDOs that are being insured were the very same ones that have been rated AAA, when in reality they are high-risk, poorly rated investments. This meant that for the holder of the CDS, the reaction was huge potential gain, since the investor risk was tiny and the return on investment could be huge, whereas the reaction would be fatal to the underwriter. In 2007, the culminating reactions started by the revolutionary financial reform and the Financial Services Modernization Act take their final form. As economic growth slowed naturally, millions defaulted on their home loans, sparking a rate of foreclosure never before seen in America. Once these loans were defaulted on, the CDOs made up of these loans, many supposedly AAA rated, failed. The failure of these loans halted the subprime market as lenders had nowhere to send their subprime loans because no investment banks could sell them. This forced many lenders who were holding subprime mortgages to fail. This also ruined banks, even driving Lehman Brothers, a top investment firm since 1850, to failure. A chain reaction trickled down to the shareholders of these banks as well, causing their investments to drop over 50%, sometimes even becoming a complete loss. In addition, it crippled those investors holding subprime-backed CDOs. These investors lost most, if not all, of the money they had invested. This, in turn, caused the stock market to drop 54% over the course of the next 2 years, starting a global recession, a reaction we have yet to escape from. Reciprocating the losses felt by investors, the corporations underwriting these CDOs also experienced massive losses. AIG didn't believe these bonds could fail, and therefore did not have enough capital to pay CDS holders. AIG would have failed had the United States government not reacted with a revolutionary $182 billion cash infusion in which they paid all CDS debts in full while taking partial ownership of AIG. What this meant was that the only investors who didn't lose money were those holding credit default swaps for the very CDOs that failed. The collapse of the banks forced the hand of the federal government in an unprecedented manner. Reacting to the recession, the American taxpayers were forced to foot a bill of approximately $11 trillion in order to stimulate the economy, as well as bailing out other corporations such as Bank of America, who bought out a defunct Merrill Lynch, Bear Stearns, and Citigroup, to prevent further collapse of the economy. All of these effects and their ultimate reaction, the current global recession, were the result of much reform spanning a long period of time. However, all reactions have a cause, and the catalyst behind the global financial crisis, the reform that marked the beginning of the end, was the Financial Services Modernization Act. This legislation created a revolutionary change in the banking industry, loosening regulation and dooming the economy through the subprime mortgage crisis. We are left in a world reacting to this reform by cutting use of the American dollar, causing a revolutionary change in worldwide monetary policy. Our country holds the responsibility for the global recession. Financial reform detailed in the Financial Services Modernization Act of 1999 is to blame.
Credits. Okay. So that's the banking industry. Alright, comments on that? Have a good little break here. We'll